What's going on, guys? It's Henry back with another video, and today I want to teach you guys all about put credit spread. These are the best strategies that I have for growing a small portfolio, but also I utilize this strategy all the time in my bigger portfolio. As you guys can see right here, I'm using this strategy on Amazon, I've used this strategy on Airbnb, on Coin, on Nvidia, and today I want to show you guys how I'm going to use this strategy for Tesla, because honestly, when I've looked at Tesla has had a big pullback, so it's a very interesting time to play this stock right now. Now, I'm also going to go over my Tesla position, the Tesla chart, how the mechanics of a credit spread work, so you're in for a real big treat today. Real quick, if you're into crypto, then you can check out BlockFi. They give you a deposit bonus when you sign up, and also they do have a credit card, so I'm going to leave both of those links for you guys in the description. All right, so I hold a lot of Tesla. My average price is $589. Currently, I hold 520 shares, and I have a whole lot of options on Tesla right now. I'm actually running 6 different strategies. The biggest strategy that I'm running is selling Tesla put options. So I'm currently selling the 840 put option, and really the reason for that is if you look at the 3-month chart on Tesla had a big run up to $1,222 per share on November 5th, but slowly this stock has been declining, and right now where it's sitting at under $900, I think is basically a steal, because honestly, if you look at the 1-year chart, Tesla's coming back to the levels that was trading back in October. I'm going to click into Tesla 500 and 490 put credit spread because I want to show you guys how profitable this strategy can be. As you guys can see here, I made $11,480 on a put credit spread on Tesla, and this is what I plan to do again for Tesla stock in this video. Now, real quick, a put credit spread is an income generating strategy. It's where you're collecting income for selling one put option and then buying a different put option to close off your risk. Selling put credit spreads is one of the best strategies because it gives you safe exposure into a stock. Now, with that safe exposure, you also get paid in income. You get a premium day one as soon as you sell the put credit spread. Let me show you the mechanics and how this works. I'm going to click view all options for Tesla. Now, the way you set this up is you go to sell put option. You start off this position by selling one put option and then buying back another put option. For example, you would sell the 890 put option and then buy the 885 put option. But there's a whole lot of different best practices that you want to include in doing this, because if you were to go for 890 and 885, this would be really close to the money. Instead, what I end up doing is I do out of the money put credit spreads. I pick specific strikes. I'm going to show you guys what I specifically look for when I pick strikes. But first of all, I need to pick an expiration date. December 23rd is only 2 days away, so you want to give yourself enough time to play out the position, and also the further out you sell, you will get more income. But you don't want to go too far out, because then you're just waiting on the sidelines for a really long time, and although you did get your premium, it's much more profitable to go for about a 2 or 3 month option. For me, that's the sweet spot. So since today is basically January, I'm going to go out until March 18th, 2022. So this is going to be the monthly option that expires in March. Now, what I'm going to do, and what's really nice about Robinhood, is they tell you the chance of profit. Now, I'm typically looking for a chance of profit between 80 to maybe 90%, depending on my view of the stock. Now, for Tesla stock, because I am a bull in Tesla and I do believe it's going to go up by March 18th, I think this stock is going to at least maintain about $900 per share, but honestly might even go up to $1,000. However, with the put credit spread, you actually make money when the stock doesn't fall, which means that if Tesla stands still and continues to be $897 per share, you'll actually make money. If Tesla goes up past 900, 950, it doesn't really matter, because you're still gonna make money. The only time where you're not gonna make money is when the stock goes down to your strike price that you have sold. So because I told you guys that my chance of profit that I'm actually aiming for is going to be between 80 to 90%, I'm going to scroll down and go for an option that I see that starts out at least 80. Now you guys can see I have sold a 790 and 780 put credit spread in this portfolio already. Now I already had this position open and I'm up on this position currently. So I'm going to go down even lower, because since then Tesla has pulled back. Now, honestly, you guys can see that Tesla has pulled back, but this position is still profitable for me. Now, the first option that begins to have a chance of profit of 80%, by the way, if you're using a different broker, you can also look at the delta. So if I expand the delta right here of 675 strike, it's about a 15 delta right now. The sweet spot for selling a put credit spread is going to be between 10 to 15 delta. So this is the point where I start to look at selling the first put option. Now, $675 per share is a very low price for Tesla. So basically, the only way you would lose money here is if Tesla stock pulled under $675. Only at that point would you start to lose money. So what I'm going to do is I'm going to sell the 675 put option, and now what you want to do as a step number 2 is you want to buy the next leg down. What that looks like is first you just go to buy, and then you buy the next leg down. I'm going to buy the 670 strike put option. Now, the reason why I'm doing this is when you sell a put option at $675, well, you have to have the collateral for $675 per share, which is actually $67,500. And I don't know about you guys, but most people don't really have that laying in their account. I mean, I currently do, but usually that's not the case because I'm usually fully invested. For most people, they want to know strategies that are going to grow a small portfolio. And this strategy right here only requires about $500, and you're going to see that I'm going to make a very good return. So right now I'm going to buy puts. I'm going to buy the $670 put option. And what that did right there was I completely closed off the trade. Now my max risk is only between the strikes of 675 and 670, because even if the stock went down to zero, it wouldn't matter since the 670 put that I'm buying is protecting me. Now the total credit is $1, which is really nice and easy to understand. We're putting up $500 worth of risk. We're collecting $100. So actually our max loss is only going to be $400. So we're collecting $100 for $400 worth of risk. And if you do the math there, that's going to be a 25% return by March 18th, which is 3 months away. Now, if you run selling put credit spreads like this every 3 months, and you were able to do it every 3 months at 25%, that's actually a 100% return in one given year, which is why I love this strategy so much. You can double your portfolio every single year as long as you pick the right stocks and they don't go below your strike price. In this example, that would be $675 per share. So you really want to run this strategy on stocks that you have conviction in and that you believe in. And third, you want to have exposure in. So for me, I want to have exposure into Tesla because I continue to like the stock. Now, another thing that I look for when I sell the put option is I want to make sure that implied volatility is high. For Tesla, it's 66%. The reason why you want implied volatility to be high is that you collect more premium. But the second byproduct of high implied volatility means that you can go very out of the money. If you look at Tesla, $675 is a very, very low, far out price that is not near the money. However, we're still making $100 for $400 worth of risk, or 25% return, even for such a low risk option. The 3 months mark is really a sweet spot that I go for, but you can also do monthly or even on a weekly basis. You can sell put credit spreads. However, you will make a little bit less money going weekly because you're going to be collecting 1 to 5% return. However, if you're able to duplicate that week in, week out, then you can actually end up making 20% per month. Now, the only problem with that is that you don't have much wiggle room. So if you are wrong once in a while, you will have a very big drawdown in your portfolio since you have the capability of losing so much money and you're not collecting that much in return. But for example, in this position, I'm collecting 25%, but historically speaking, I've been successful maybe 95 to 96% of the time. So even when I do lose, it's so far and few between that it does have an impact on my portfolio. However, the amount of money that I collect is always exceeding the amount of money that I lose. Again, guys, I hope this was really helpful. I do have a private Discord community that you can check out in the first link in the description, or you can also keep educating yourself, and I have a perfect video that you can watch right here.